Good morning, everybody. I'm Ernesto Burden, the publisher of New Hampshire Business Review, and it's my pleasure to welcome you to today's webinar, Building Trust in Digital Currency, New Hampshire Leading the Stablecoin Drive. Today's webinar is sponsored by Sheehan Finney, and we're grateful for that. And we're grateful for our panelists today, who are Sandra O'Neill, an attorney and shareholder at Sheehan Finney, Jeff Lepak, Director, University of New Hampshire's Interoperability Lab, Jim Kish, President and Chief Executive Officer of Passumpsic Bank, and Mark Bartram, Attorney, Shareholder at Sheehan Finney. And with that, we'll get right into the program. I'd like to ask everybody to turn on your cameras and join us. I'm going to go away and just advance the slides on your behalf. I do want to remind the audience that there's a Q&A function, so please put your questions into the chat, and Sandra will be watching those as we go along, and we'll have a Q&A session for the last 15 minutes of the program today. So with that, good luck, everyone. Thank you for being here.
Thank you so much, Ernesto. And thank you to Jim and Jeff and Mark for joining me on this panel. So stablecoin transactions. Ernesto, if maybe you could just flip to the first page. Before we really dive into stablecoin, I wanted to give an overview of what stablecoin and cryptocurrency and the blockchain are. Crypto is a digital coin that is shown by a chain of digital signatures. So if you think about, when you put money in the bank may have an account. Now with electronic payments, you don't necessarily even use cash. And cryptocurrency sort of takes money transfers to the next level where you don't even need, necessarily need a banking institution. And it does so by creating, in some ways, this public ledger where each owner transfers a coin to the next owner by digitally signing the transaction. And then there's a public key. So everything is verified on a public ledger in the blockchain. And the blockchain is the chain of ownership of these digital signatures. And stablecoin, I would say, but open this up, is really in some ways a hybrid of a compromise of digital money with money that we have traditionally used, which is backed by a national government. And so, the most common stablecoin is backed now by US dollars. And what you can do with this is you can, use the digital asset on the blockchain, but the asset has to be redeemed for a fixed monetary value, which is US dollars. And so what is the purpose of the blockchain? Really, it was developed as an idea to finance monetary transactions without third-party intermediaries. And we'll discuss as well how you can use the blockchain to execute contracts instead of through different trusted parties and legal documentation on using a digitized form of execution. And so with that, I'll turn it over to Jeff to dive more into the details of crypto and the blockchain.
And one thing, Sandra, just before you move on to that, onto the deep dive here, one of the things that we're going to be talking about today, which is really super interesting, is that, we're moving from, kind of decentralized, this decentralized finance operation and moving it more into kind of more aligned with the traditional things that we're doing. So it's a pretty exciting time, and we'll explore more about what that means to the market and all the economic opportunities for the state.
Great. Thank you, Jim.
Awesome. So I will step in to talk a little bit more about the kind of the underpinnings of blockchains, just to get everybody kind of level set. So that was a great introduction, a little bit about stable coins, but a little bit about some of the features of it. But really, I think a lot of people get confused on what a blockchain is. They know it does a bunch of finance stuff, but how does it actually work? And the key takeaway here is what Sandra started with, which is it's really kind of a shared digital ledger. We're talking about a set of transactions. And in the case of blockchain, the name blockchain comes from the concept of blocks of transactions. So you bundle up a bunch of transactions, then there's typically a rule set on how to process those transactions together, how to distribute them across all of these parties that are participating in the blockchain, and then a way to drive consensus or validation that those transactions are legitimate transactions and that they're ones that are supposed to be recognized. And you take those blocks and you stick one block onto the chain of blocks that came before, and you have this really long ledger that goes all the way back to the beginning of time, and the new transactions keep getting added on. So that's the blocks and the chain part of what blockchain technology is. So a couple key takeaways here. One, it's distributed, and there are lots of distributed systems, but blockchains are kind of by definition a distributed system. So it's shared across multiple computers, multiple nodes. They're blocked. And again, there's some sort of consensus-oriented mechanism here. There's some rules for processing. So if we jump to the next slide, we'll dive a little bit into some of those consensus mechanisms and features. I think one of the things that people really got excited about when blockchain came out is the concept that it really can add a couple of key features to transactions. One is transparency. And again, there are ways to do private blockchains as well, but most of these features are things that you'd experience in a public blockchain like Bitcoin or like Ethereum. And transparency comes in a couple ways. One is that basically anybody can participate. You're sitting in the audience now. It is entirely possible for you to set up a node and start participating in that system. They can become trustless in that you're part of the system, and you can go back and verify those transactions. You can have your computer go in and say, is this right? Did those things make sense? You're not reliant on a third party. And there are lots of third parties out there. There are lots of clearinghouses. There are lots of credit card networks, those types of things, which we typically rely on. I go in and I swipe my credit card, and the good old Visa network is doing a lot of this background work for me, whereas in this case, it's a distributed system that I can verify. And then it carries redundancy as well. Because it's a distributed system, you can, if you want to, have the entire history of that particular chain. You can go in and actually track the whole thing through. So those are some key features. And the other big thing that people get confused on is the consensus mechanism. So how do we know when we bundle that block of transactions together that we did it right? So basically, there's usually a check mechanism. There are two big ones that most people would be familiar with. One is called proof of work, and the other one is called proof of stake. They operate very differently, and the two biggest chains I'm going to talk about, Bitcoin and Ethereum, both use a different mechanism. So proof of work really relies on very challenging math, which uses a lot of energy, provides a high level of security. That's used in Bitcoin. And so people who are doing that work get rewarded in Bitcoin because it's hard work. And they're providing the resources to do it. And that's really how that mechanism works. And then the cool part about some of the digital algorithms is that it might be hard to do the original calculation, but usually it's very easy to, once you know the answer, work your way back to it. And so someone can come up with an answer, and then quickly everybody else can say, yep, that's exactly the right answer. We all agree that that's the right answer. Ethereum, on the other hand, uses a completely different consensus mechanism. It uses a concept called proof of stake. And basically, this is the economic-driven version. Let's put your money where your mouth is. So to participate, you have to kind of stake some money. And if you're caught lying, you lose it, right? So that's how they make sure you're doing a good job, is they say, you're putting your own kind of value at risk. This can be higher throughput, can be faster. It's much, much more energy efficient because you're not relying on mathematical difficulty. And there are a zillion other consensus mechanisms, but those are the kind of the two big ones. So that's kind of just a little bit more on the tech side. And so the next.
Sorry, Jeff, just to ask the question, and this is in some ways to prevent fraud, correct?
Absolutely. It's super important because, again, you have to both figure out a way to do the math to make sure the transactions are valid, and then a way to come to consensus that they are the right ones, that was a valid interpretation, and that there is no fraud. Certainly, there are weaknesses to distributed systems where fraud is possible. Like if someone controls more than 50% of all of the processing power, so like 50% of all the nodes, theoretically, it would be possible to kind of get to consensus with your group um, and put transactions in that you were interested in. In practical reality, that's really, really challenging to do. But all these mechanisms have a lot of back checks to make sure that they're working in an efficient manner. And again, you can always get caught later too, right? It might fork the chain a little bit, but again, because it's a public ledger, people can come back in and go, wait a minute, but something went weird here. I can't remember a time that's ever happened, but theoretically possible. Some example use cases for blockchains. Everybody's excited about cryptocurrencies, and most people just translate that directly to each other. They go, oh, crypto equals blockchains. Certainly the biggest use of it, but not the only use. So I just want to go over a couple of these. Cryptocurrencies, you might be familiar with these, like Bitcoin. I think everybody's familiar with Bitcoin or Doge or some of these other I'm going to call them scam coins because this is a little bit of a wild west out there still, where people kind of, are building excitement around stuff that doesn't really have much backing. And cryptocurrencies are different, right? They are generally not government authorized, right? So unlike the US dollar, these are digital representations. So generally means that they're non-fiat too. There's a rule set to how that currency is created or minted. So it's not the government saying, oh, we need to print some money right now, and they go ahead and print it. There's a rule set. So in Bitcoin, there's a way that more Bitcoin is mined and Bitcoin is created. That's an algorithm, so you can go check it. They can be as varied as any currency throughout global history, right? So stablecoins, great example, that's tied to some sort of commodity. In the case that we're going to talk about today, most of the ones are tied currently to the US dollar. So it's a digital representation, but there's a reserve associated with it that's basically says we got that commodity in the back that we're pegged to. And largely, I think governments see this as a threat, right? Because it's something they're not controlling. So you'll see a lot of government legislation, a lot of rules coming into place. And I think that's where a lot of the conversation will go today about how we interact with this digital universe now that they're fulfilling a role that typically would be done at the more federal level. Beyond cryptocurrencies, of course, we can also do decentralized finance. So there's all kinds of financial instruments that could be created that don't necessarily have that same third-party transaction authority, which is probably the biggest use case right now. And I think Jim and Mark will talk a lot about that in the next couple slides. Blockchains can also be used for NFTs. People probably remember a lot of artwork being tokenized in the not too distant past, where you're buying a picture of a monkey for ridiculous amounts of money. I think that's a bad example of how this can be used, but it's really cool that you can create kind of an ownership record of a physical or digital asset through a non-fungible token that's tradable in this digital space. That's super powerful and will have tons of use cases. And I'm personally predicting that'll be the single biggest outside of finance use case as we move forward. And then smart contracts. So Ethereum is kind of known as the global decentralized computer, in that what it allows is kind of programmatic code to happen, which everybody refers to as smart contracts. And that's how a lot of this is set up. There's a program that has these binding, unalterable rules that get executed based on conditions happening. And as soon as those conditions happen, that contract executes. And so this is a very powerful concept of it. We can set up rules in advance when certain real world actions happen, or when certain digital transactions happen. A bunch of other things can happen in line with that. So it can be used to control things, like a will or a trust potentially. We can set up governance organizations. In fact, that's a big use case as well. It's called decentralized autonomous organizations. And the state of New Hampshire actually allows those groups right now to register as a business entity in the state, which is super cool. It allows just a lot more of a digital presence, but doing real things. And it doesn't rely, again, the cool part, because it's a computer, doesn't necessarily need my involvement. Once we've set the rules, it's going to execute all by itself, rather than waiting for me to go to the bank and drop a check or get somebody else's authority. If all the conditions are met, and that might be digital signatures, it's going to happen. And we can trust that it's going to happen and then verify it. So I probably bored everybody to death with a lot of technical background. So we'll jump more into stable coins, but sometimes I think it's really helpful to get kind of a little bit of a tech grounding before you jump into the use cases.
Thank you. So this is, the hypothetical. What if all payments are made on the blockchain? Right now, stablecoin, there actually has been 9 trillion in total transaction volume over the past year, and that's more than one half of Visa's payment volume, more than 5 times PayPal. And currently, the typical use for stablecoin is in crypto trading settlements, and also, quite frankly, transferring money overseas. A lot of foreign countries use US dollar-backed stablecoin to finance their own transactions. And stablecoin issuers now, because they have to redeem for a commodity, as Jeff mentioned, collectively hold $150 billion worth of US treasuries. So the issuers can actually be extremely profitable because they do not, and as Jim will talk more, they do not pay interest on deposits. So they earn money from their investments in US treasuries. And because they're digital creations, they have low overhead. So it is a very profitable industry. Next slide.
All right. I'm going to talk a little bit about the Genius Act, and thanks very much, Jeff and Sandra, for setting this up, because what we see here is a whole world of new opportunity. You could have a stable contract where you could bet on the weather. You can create really interesting products that we're thinking about in the banking sector that we can replace like existing rails. And there's a whole bunch of new entrants with all of those 250 million in stablecoin in circulation right now. It's where a very mature, blockchain technology meets kind of, more of our institutional sides of our business. So we need some rules. We need to mitigate the risks to our businesses, the risks to our institutions. So along came the Genius Act, which was enacted in July of this year. And that's, as you can see on the screen, stablecoins must be redeemable for a national currency. US dollar, the most common. So that allows anyone with a US dollar stablecoin backing is to have the strength, the lack of volatility of the USD, which is great. So it has to be 1-for-1 reserved with US coins. Currency treasuries are very common. And we're looking, as a banking industry, is tokenizing the deposits. So a 1-for-1, a deposit of $1 in the bank has the equivalent of a dollar backed. It will back that deposit 1-for-1. So you have the freedom to transact in very modern rails, and we'll talk about that, while maintaining the value simultaneously. So it also allowed for approved issuers. That means depository institutions such as our bank and other credit unions to actually issue stable coins. I think the form it's going to take are probably some consortiums, because there are large, kind of large banks that could do this on their own. But we look at the bulk of the banks inside of the New Hampshire and outside in the U.S., there's many kind of smaller community institutions. So I imagine they're going to work together to create their own coins. And then it also approved issuers that could be a state and federal qualified payment stablecoin issuers. So there's some real specific rules on what constitutes those issuers, which we don't have enough time to get into because that's a whole other detailed area. Under transparency requirements, not only does they're on chain, everything is full transparency, But there is also, in addition to that, there's some additional requirements of monthly certification by a registered public accounting firm to the regulatory bodies. And we talked about this notion of no interest allowed on stablecoins accounts from issuers. And this is really a design of, these are payment mechanisms. So they're called payment stablecoins. And so there is a prohibition. And then also, I'll talk or just speak a little bit to what's going on around the follow-up to the Genius Act, and that's called clarity. That's really the rules for the road. And one of the things that was the House bill and in the U.S. House that did two things. It regulated what crypto assets and intermediaries are going to be regulated, but it also said, and that is either the Commodity Futures Trading Commission rather, and the Securities Exchange Commission. And so that there's some specific, that's that next level of clarity on how we're going to actually regulate the rules of the road. And it also, it's important to note that in there, they're really specifying this notion of no interest. Right now, there's a loophole out there, and that is companies can offer rewards in lieu of interest, and it looks a lot the same. But it's important from a banking perspective and from our state's perspective is that we want to keep these dollars local within the state, because then lending institutions can re-lend those, and that provides a lot of economic benefit.
Yeah, I think that's a really good point, Jim, because currently, if you put your stable coins in an exchange as well, not just one of those local companies that's maybe doing a points program, but the exchanges currently also offer interest for, having you store your stable coins with them. I think the Clarity Act is exactly the thing that will define whether that's actually okay or not okay. Because right now, like, I earn interest on my stable coins, and it'll be interesting to see that as it evolves out of out of the Senate.
Yeah. I'll keep going on this one here.
Yeah.
Yeah, there's some the points up on the screen here are, as you can see here, there's stablecoin commissions to adopt a state regulatory framework. Issuers with fewer than 10 billion of outstanding stablecoins to opt for a state regulatory regime. A New Hampshire department to oversee this issuance and regulation, I think, is really important. Also, I'll speak just a second or two to a stable. I'm on a stable study commission, which I was appointed by the governor, and that came out of a specific regulation or a House bill for New Hampshire. And really what it's designed to do is do some exploration around the opportunities that we could avail ourselves at the state level, and then look at really critical areas such as fraud prevention. We want to make sure that we have a handle on consumer risk for folks that are participating or could run across networks, and make sure that we don't put our state residents at risk. Does anyone want to cover the taxation side here? Probably.
Sure.
Yeah, thank you.
Yes, absolutely, Jim. Thank you. And yes, I definitely, since you're on the Stablecoin Commission, it's great to hear about your experience on that. And, one of the things part of the reason for this forum is I looked into the tax issues surrounding cryptocurrency, and part of the challenges with crypto is that, the tax rules don't really know how to think about crypto. They've tried. I mean, the regulations, so the Inflation Reduction Act, they passed a series of laws to try and amp up tax reporting for crypto trading, including stablecoin, because there was a thought that, a lot of people were trading in these assets and making money and not reporting the gains. And so Congress passed legislative reporting requirements. So on the federal side, cryptocurrency is even stablecoin. It's not treated as currency. It's taxed as property. So any gains or losses have to be reported. There's no de minimis threshold for that, as there is for foreign currencies. And then as part of the Inflation Reduction Act, actually starting for this year, brokers, including Coinbase, the other exchanges, they have to report dispositions of cryptocurrency, including stablecoins. And the odd thing is, if you redeem stablecoins for cash, that has to be reported to the IRS, which is sort of bizarre because, basically it should be the same asset, but any disposition in excess of $10,000 must be reported. Although the regulations that came out say that if you transfer stablecoin for another digital asset like a Bitcoin, that does not need to be reported. So that I think was sort of the compromise. And finally, Congress added a law saying that for purposes of kind of fraud detection, they are going to treat transfers of stablecoin in excess of $10,000 as a transfer of cash. And so that will also need to be reported to the IRS, although they have not issued guidance on that piece of legislation. So I think in theory that's not quite, it doesn't have to be executed at this point. But as you think through, I mean, a lot of the comments that came out on these regulations is why not actually use the blockchain for these reporting mechanisms so you don't have to issue these paper reports. And I mean, you could even issue tokenized W-9s on the blockchain and sort of take advantage of the technology so that you don't have these duplicative reporting efforts. So that's something to consider. And New Hampshire should consider as well, because there is a question if you have a New Hampshire stablecoin issuer, will that issuer be subject to the New Hampshire business profits regime? Will they then have to make these, reports? And, something to consider is that, and you're exempt on treasury interest, but, you still have to report. But is this another avenue where we could use the blockchain to sort of reduce all these paper reporting mechanisms or even electronic reporting mechanisms that we currently have? So
Yeah.
something to consider.
And there are a lot of, to that point, there are a lot of folks doing that work right now of how to create really robust mechanisms of doing some of those financial reporting activities on chain, with a big focus on interoperability, because you might have different chains where some of your financial information lies, and how do you create trust between those and create that reporting mechanism that really makes sense. So there's a lot of activity in that space right now.
Great. Okay, next slide.
All right, the fun part, we get to talk about some use cases because it's really hard to say, what do we do with a stable coin? I get it, it's on the chain, it's dollar for dollar, but what is the average person, or where is this headed? Now I'm going to start with the Jetsons, the cartoon, and Rosie was the robot that took care of the house and so forth. And I'm going to start with the agentic commerce, and this is an area where instead of giving our robot a credit card to go shopping for groceries, our AI agents of the future, those that work right alongside us, can be doing transaction for us. In fact, we've seen and modeled out where two AI agents or several AI agents in a chain could be doing commerce between each other. So imagine your refrigerator ordering milk for you, and there's an agent at the grocery store that's accepting the stablecoin payment for exactly the amount, and then making sure there's enough for delivery. And that's really kind of where this thing is headed. I'll start with some more practical things as well as the Jetsons, but pooled funds and investments, as Jeff was talking about, the blockchain has the transparency. In fact, you can download a node and see it specific. If you know what the hash number of that account number is, you can see those transactions. So we can really envision where there could be large funds that you could provide transparency to everyone that participates. So if there's a nonprofit that wants to raise money for a particular project, imagine the stability of a stable coin, but also the transparency of putting each and every one of those contributions outside of the blind, outside of a bank account, but can see that transactions if you have a particular hash number to see that kind of thing. Cross-border transactions, very, very common. We talked about, I know that Sandra mentioned the remittances back to home countries and so forth. And a stablecoin provides that stability, I think, is really important. Cryptocurrency investments. I think investors and traders like to be able to sideline the funds and not exit out of fiat when there's when they want to exit out of a particular investment, and also provide some trading liquidity. Facilitates this quick swaps between two different types of investments. So I think it's a really powerful applications. And I like some things that smart contracts can provide along the way through multi-signature wallets. And that means that imagine a product a modern banking product where you could help your aging parent by providing a sign off on particular transactions before they go out. So it's a way of working alongside another member of your family to provide some assurances that maybe payments that are unusual would have to have another set of eyes looking at them. And smart contracts and these types of technologies make a lot of those things possible.
Yeah, so I come at this from the fiduciary perspective. I work day to day with trustees and executors and beneficiaries and estate planners. And these digital assets, they aren't theoretical anymore. They're showing up in trust and estate administration. We're seeing them in inventories, account statements, and even direct funding transactions into trusts. Um, you know, a lot of plans were drafted before anyone was thinking about wallet custody or private keys or exchanges or tokenized assets. Trustees may not have real clear authority or written guidance on custody or access or valuation, and certainly not for fiduciary accounting. So the question is, it isn't whether trustees will run into digital assets. They already are. The question is how we manage them prudently. Using the same core duties of care, loyalty, record keeping, transparency. We're not asking trustees or estate planning attorneys to chase innovation. We're saying governance and authority, custody, valuation, and documentation. They all have to be strong enough for what clients are already own and what's already entering into trust and estates. Next slide. So these scenarios, they're not rare anymore. They're showing up in everyday trust and estate work, often without warning, and before a fiduciary has really built a process around them. One example: a grantor funds a trust with stablecoin instead of cash. Clients may treat it like it's digital dollars, but the trustees still have to sort out authority and wallet control, approvals, valuations, documentation, and accounting. Another example is an executor discovers crypto through an exchange account, an email, password manager, or some partial inventory. And the reality is court authority isn't enough if access credentials are missing. And moving too fast can also create tax and reporting issues and some beneficiary dispute risks. Third, a directed trust, split custody, and investment authority. A specialist can manage wallets and keys while the trustee handles oversight, accounting, and compliance. That reduces the operational risk, but it doesn't really remove the fiduciary responsibilities. The common thread is surprise and pressure. Urgency can't override process, and the right response is on the fiduciary side is to pause, confirm authority and control, document the valuation and make sure every step is defensible. Before transfer or conversion. Next slide. So digital assets can move fast. Once a transaction goes through, it's often hard or even impossible to undo. From a fiduciary standpoint, that makes the upfront questions even more important. So the first question is there authority before a trustee moves or converts or distributes a trust asset that's a digital asset? They have to confirm the trust actually allows it. Does the document authorize holding digital assets? Does it allow conversion to cash? Does it permit using custodians or advisors? So if the authority isn't clear or outdated, moving forward without clarity really adds unnecessary risk for a fiduciary. The second is control. Legal authority probably isn't enough. The trustee needs real, practical control over the asset. They need to know where it's held. they need to know who controls the private keys or credentials. They also need to know what approvals are required to move it. So if a third party controls access, like an advisor or a custodian, the trustee really needs to understand the setup and then document it clearly. Third is valuation and accounting. Trustee has to be able to support the numbers. So, even if stablecoins need documentation of fair market value at receipt, transfer, or distribution. So the trustee should be able to explain how the value was determined, what the source was, and how it'll show up in fiduciary records and tax reporting. So the takeaway is simple. Authority and control and documentation have to come before execution. If any one of those is missing, the prudent move is to pause, gather what's needed, put governance in place, and then act. Next slide. There are real compliance risks here. I mean, we sort of talk about this in everything's public. You can see the public chain, but there's still often uncertainty and overreaction around digital asset and where it comes from. Trustees don't need to treat every stablecoin transfer as suspicious or automatically reportable, but they need to know when existing compliance frameworks apply. So you start with the basics. High value or cross-border activity can raise anti-money laundering or bank secrecy or OFAC issues, depending on the facts. The trigger isn't that the asset is digital. It's the same risk trustees already face and already have to watch for, which includes jurisdiction, who the counterparties are, and what the purpose is. So a stablecoin transfer tied to an offshore exchange or to a foreign wallet deserves more scrutiny, perhaps, than a transfer between known internal accounts. And documentation really becomes key. Trustees should document the source of the asset and the purpose of the transaction. That means why it was received, why it's being transferred or converted, and how it fits within the trust's objectives. Exchanges and wallet providers or custodians should be treated like vendors. They aren't just tech platforms. They're third parties handling trust assets and access credentials. So trustees should be doing their due diligence, reviewing controls and understanding the risks. And one more point: stablecoins aren't cash for currency transaction report purposes, but as Sandra mentioned, there are still reporting requirements to the IRS. So a large stablecoin transfer doesn't automatically trigger a cash transaction report to FinCEN, but the reporting depends on the context, who's involved, and why it happened. So the goal isn't to trigger automatic reporting, but it's still thoughtful risk assessment that requires solid documentation and compliance that matches existing fiduciary standards. Next slide. So, in a lot of estates, the biggest digital asset problems aren't market related; they're document and access related. Which is why the best risk management often starts upstream with better drafting by our trust and estates colleagues. For modernized documents, the key is explicit digital asset authority and wills and trusts. Trustees and executors shouldn't have to lean on implied powers or general powers or outdated boilerplate. Clear language can cover holding digital assets, using custodians, delegating management, transferring or liquidating positions, and taking steps needed to secure access credentials. Powers of attorney need attention too. An agent under a power of attorney might work fine for banks and brokerage accounts, but it can be useless for digital assets if it doesn't line up with the RUFADA, the Revised Uniform Fiduciary Access to Digital Assets Act. Say that 5 times twice or fast. In practice, an agent may need clear authority to access, manage, or recover assets in online platforms or exchanges or custody accounts. It also needs to keep a secure. It also helps to keep a secure separate memo for credentials or recovery steps. Most clients shouldn't put private keys or full credential information inside a will or trust. Those documents can be shared widely or filed with a court. So a better approach would be a separate secure inventory that says where the assets are held, how recovery works, and where the needed info can be found. That gives the fiduciary a reliable path to access without creating additional exposure. So legal authority isn't enough, though, without practical access. An executor can have court papers and still be locked out if nobody can find the credentials, or if a multi-factor authentication is tied to a lost device. So that's why clear inventories and recovery plans really are important. Not every crypto holder is a crypto expert. So that client can dabble in this and create a lot of difficulty later on in life if they don't really understand all the rules and access. So the goal is simple. Make sure the fiduciaries can find what exists, prove authority, and regain access in a way that's secure and documented and also workable. Next slide. So let's take a look at how this could work in practice with the New Hampshire example. So it's a directed trust under New Hampshire law. It receives $500,000 in USDC, not as a speculative investment, but as a liquidity and transaction tool. So in this structure, a digital asset advisor manages the wallet. They handle the operational work, like wallet administration, executing the transaction, and managing the keys. And they do it under the trust direction provisions. That lets the trustee avoid holding private keys or making blockchain transactions. Instead, it's being managed by that third party that's authorized under the instrument. But the trustee can't just step away from their responsibility. Trustee still owes duty of oversight and accounting and compliance. That means confirming that the advisor stays within their authority. It also means confirming transactions match the trust purposes. And it means making sure valuations and reporting are accurate. In the accounting, the stablecoin is listed as its own asset, and the valuation method and transaction records still need to be documented. Annual review by a fiduciary is a key control. At least once a year, the trustee should be reviewing activity to confirm it followed the trust and any reporting requirements. It's also a chance to reassess the advisor, the custody setup, insurance coverage, and any other legal or guidance changes. So the takeaway is simple. New Hampshire's directed trust offers flexibility without giving up fiduciary discipline. It separates the digital asset operations from traditional trustee functions, but while keeping accountability, oversight, and documentation in place. So that the tech may be new. Realistically, the governance principles remain the same.
Thank you, Mark. I just threw out Argentina, and I can go through this quickly just because Argentina is a country that's been using US dollar-backed stablecoin, partially because of their historic inflation. The peso has been devalued, and so local people on the ground prefer to use US dollars, and partially because they don't like the local banks. And I throw that, what I found interesting in talking to some Argentinian lawyers is they don't have any regulatory regime governing the use of this currency, and really actually are looking to the US for guidance. They defer to the US SEC, and they've deferred in some ways to the Genius Act and the regulation of stablecoin to help guide the use of US dollar-backed stablecoins in their country. You can next slide. And so in thinking about that, I think really the US is looked to because of, in many ways, the trust-built regime that has been established by our governing structures. And so, what does that mean going forward as we try to tap into these digital currency markets where, in some ways, the use of digital currency is meant to void this governing regime and perhaps we can look to other countries and how things are used on the ground to think of maybe there's a way for a compromise. And Jim spoke about this with the Genius Act. Perhaps it is a compromise to allow for use without a huge burdensome regulatory overlay, but still have some guardrails. And so with that, I'll turn it over to the last slide. And Jim, maybe you can, take the lead on that and the takeaways.
Yeah, you bet. I think we do have one point up there on the first issue of the municipal bond backed by Bitcoin. I think that's super interesting. So that's the Business Finance Authority approved first of its kind. It's $100 million Bitcoin backed. It's a conduit bond. So think of a company or nonprofit organization out there that wants to raise some money. They can find the investors. They can find a private custodian to put up some Bitcoin to cover. This is going to be over collateralized. So that means that the taxpayers of New Hampshire will not be on the hook if for one reason or another they can't make repayment on the bond. So that provides that coverage. I think that's really interesting. I don't know much of the details. I just know that it's a really different approach, and it's really well covered, meaning that you have to have substantial amount of Bitcoin be above and beyond what you need for the bond on BitGo. We talked today about some different scenarios about how to leverage the blockchain. Jeff talked about the blockchain in detail, and we layered on, all the other things, the different use cases and things on top of a very mature chain. So I think transactions are going to get quicker, more visibility, I definitely more efficient into the future. But the takeaway for me is that we're at a really exciting time, and there's a lot of opportunity ahead of us.
Great. And I think, Ernesto, with that, we'd love to turn it over to questions.
Okay, wonderful. And Sandra, I know that you had some questions that you were going to ask of folks, and we do have also some questions from the audience. And if you've had time to review them, and if you want to take them, or I'm happy to ask away.
Oh, sorry, I have not had. Actually, Ernesto, if you wouldn't mind just asking the questions from the audience, I think we can.
Absolutely not.
Thank you.
I would not mind. I mean,
Okay.
to begin with, this question came in early in the presentation, and it is, what are the different strategies for maintaining asset value in the collateral for stablecoin? For example, treasury bonds, which decline in value pledged as security.
I'll take that to just use, without going into a lot of specific detail on a transaction by transaction basis. The one example I mentioned with the Business Finance Authority is that these generally are over collateralized to a great extent, so that we just always are preserving value and providing coverage in the specific, and I think that's probably the closest example that we see. And treasuries are not as volatile as Bitcoin for sure, but I think there's some stopgap measures you can put in place.
Okay. We had a question also from the audience, really more about infrastructure of technology infrastructure. So wondering if the adoption of stablecoin would result in a large influx of data centers here in New Hampshire and the environmental concerns that go along with that.
Sure, I could probably start to answer that one. Largely, I think economics really drive all of those things, and we haven't seen a huge number of data centers come to the state in the past. Mostly, I think, as the questionnaire points out, energy prices are not the lowest in the nation here in the Northeast, and that really drives a lot of those practical applications. So I don't think blockchain technologies in and of themselves are going to be a big driver or a differentiator of data centers. I think it would actually be good if we had a few more in the state. I think the other interesting thing there is you see a huge differentiation between blockchains and energy efficiency. So again, you look at a Bitcoin, which is a proof of work driven technology, that's hugely energy intensive, and it does drive up energy rates potentially because of the processing power required. Whereas other blockchains like Ethereum are something like 99.5 or 99.9% more efficient energy usage compared to Bitcoin. So, it really depends on how the technology matures. I think if we're looking at environmental impacts and data centers in general, from a pure technology standpoint, right now, I think AI is going to quickly exceed all of the blockchain-based energy consumption. People are using AI to ask when they should walk their dog, and that uses a lot of power. So I think you'll see AI dominate, and certainly the agentic use of AI interacting with blockchain will be part of that. But I think the AI side is going to be the real dominant factor as far as pure energy usage.
Jeff, I think that's a fascinating point, and I wonder if you could elaborate a little bit on how you see the incredibly rapid adoption of AI across all sectors relating to crypto generally and stablecoins specifically.
Yeah, I'd love to have Jim bop in here too, because I know he's got a lot of opinions on it. But I do see an increasing trend. Again, people love to offload activities, and if you have good governance, programmatic capability where things can be very trusted and they're going to execute the way you want it to, it's great to offload that stuff. So I think it's just you're going to see more and more and more of that. So you look at your typical financial transaction trader, right? You're going to set highs and lows and trade automatically with the particular exchange you're on. That's just the smallest possible example of agentic type activities where they might be actually not just using arbitrary limits, but you might be assigning it the right to figure out what those limits should be. Right? It might go out and do a little determination, do a little research. They're going to become increasingly complex as we go over the next couple decades here. And it's very exciting to think about that the Jetsons kind of idea. So, Jim.
Yeah, I think there's interesting is that some of the things I've been exploring are this idea that I could have a personal CFO. So to bring this down to just everyday person is that, right now we have these things that we have as reminders of like, hey, you had an extra cup of coffee this week. And what if what if your personal CFO would literally cut you off from that extra cup of coffee and there was imposing restrictions? It would pay, a virtual CFO that would pay all your bills, invest excess dollars into the best interest rate. I mean, this is the things that are very practical today. They're in that process of we're thinking about them, but the rails exist. So that's where that new frontier comes in. If you're thinking about it, you can probably build a smart contract and tie in some APIs through what are called chain links and automate that process. And I don't want to restrict coffee. I didn't want to go to the negative there. That probably was a poor example because I think you all should have as much coffee as you want.
Jim, I do like the idea of the of sort of the payment authentication, where if someone, if particularly someone who is elderly, is trying to process a transaction, either AI or a third party, a agent under power of attorney is able to sort of authenticate and verify that payment is legitimate and that should be made, and it's not someone being exploited. And I think both from the banking industry, but also from the client elder law perspective, that's a really interesting use case.
Yeah, and it hits home with one of the something that's a really big issue today is fraud.
Right.
I'm sorry.
How about tax return preparation? I mean,
Yeah.
you would think AI could be able to figure out how to work through a return and just get it done for you automatically. Anyway.
I think we have a lot of CPAs on this call who might disagree with you.
Yeah.
I would imagine there would be a challenge there in terms of having AI take on fiduciary responsibility. Can it?
Well, yeah, I mean, I think again, if you sort of put some of the guardrails in place, I think that
Mhm.
there's a lot of interesting potential for it to I mean, you probably still need someone at the end of the day involved, but having some of those additional guardrails that come up through AI, providing the background or at least the insight into what's going on is again really interesting and exciting to consider.
Another question from the audience. Can we anticipate a stablecoin issued by the state of New Hampshire similar to Frontier Coin in Wyoming?
Well, that's an interesting question. We're definitely the New Hampshire Token Commission study. We're following it. We met with them. We're definitely looking at that and some other states that are doing it. So it's hard to say at this point, to be prudent. There's a lot of research and there's a lot of better understanding there. But and then the interesting thing is that it's not a single purpose coin, Frontier, but it has very specific purposes. So a New Hampshire coin, not out of the question, of course. But what kind of purposes would it and what problems would it solve would be another thing that is still just being studied.
Thank you. And I think as a great way to wrap up would be for each of you to tackle this one, which is 5 years out. What does a successful implementation of stablecoin in New Hampshire look like? Um, is it invisible infrastructure or is it a consumer-facing product that everybody's using and trading? Sandra.
Well, I mean, this is an opportunity for New Hampshire to allow for stablecoin issuers to come to the state. And, as Jim mentioned, really to try and, in some ways, um, provide an economic home for these issuers. It's a profitable line of business. They can make money off of the treasury investments and then, facilitate the payments. I like to look at the overseas payments because why not just take that opportunity? There's a demand for stablecoin overseas. It seems like a good business case. So I guess I would start with at the ground level. This could be an opportunity for businesses that want to come to New Hampshire. It's a very business friendly state, and profit from New Hampshire's I would say pro business environment.
Jim?
Yeah, I think it's interesting. If we're looking out 5 years, and a lot's going to change in 5 years. But one of the things I think is really the wonderful side of this is that today, you know, there's an opportunity to democratize finance. I've been in the banking industry a long time and we've done a really good job, but there's still things that consumers need to understand, things they have to learn, and there's obstacles for building wealth. And I envision the next 5 years, there's a way that we can get more people could have access to more capital and more opportunity than ever before. And I think it's just going to raise the lives in the prosperity of residents of New Hampshire in the next 5 years.
Jeff?
I'm going to agree with both of my co-panelists here. I think it's an excellent opportunity for businesses to come. I think we have in New Hampshire a great tradition of enabling businesses, whether it's through wills and trusts or mutual fund law or any other numerous examples of New Hampshire adopting and making sure that we're ready for the next technology. So I think business opportunities are great. And then I do see stable coins a little bit more on that invisible side that you mentioned, which is people will be using these for so many innumerable purposes because it really is a digital, it creates less friction in the digital landscape. And so many things that require, again, physical swiping of cards, handing over of cash, those things don't necessarily need that friction. And so it's going to be a great enabler of speed and efficiency in so many ways.
Excellent. Mark, do you want the last word?
Sure. Yeah. So I mean, I see it continuing to grow. I think a couple things that come to mind. Really, having worked in compliance on and regulatory and bank secrecy and anti-money laundering. I think there's got to be we have to move slow. Because of the money laundering and terrorist financing potentials that accompany digital currency. On the flip side of that, I think there's going to be a lot of good opportunity, both in New Hampshire and beyond, for what New Hampshire offers in terms of the favorable trust laws that we have for divided trusts and directed trusts, so you don't sort of have one person responsible for all of it. You have someone that really understands the complexities that come along with digital currency and stablecoin, managing that while the client or the trustee is able to sort of leverage the advantages that come along with it without really having to understand all of the complexities.
Well, it feels like an optimistic outlook for stablecoin in New Hampshire. I want to let me share my screen again here and thank you all for being here today. Mark, Sandra, Jim, Jeff, great presentations. A lot to think about. And thank you to our attendees. On behalf of New Hampshire Business Review, I'm Ernesto Burden. Thank you to Sheehan Finney for sponsoring today's webinar. And a recording of this will be available over the next day or so. So look for that on the website or in your email. And with that, I hope everybody has a wonderful rest of the day.